Hello, hello, hello. Hi, everybody. This is Hone Tai, and you are watching the Hone Zone. And today's video, we're going to be talking all about how to create wealth in the future by taking action right now. That's probably one of the biggest things that causes people not to have the life that they want is that they lack taking action. And probably it's because they don't know what to do. There are so many different options to what you can do in this life in terms of making money. And what most people do, they get a job, they get a 9 to 5. And there's nothing wrong with a 9 to 5. I was just thinking about it earlier that a 9 to 5 and being an entrepreneur and whatever else you do for money, it is what it is, right? They're just ways to make money. It's not that one is right or wrong. It's just what is your commitment going to be to this activity? So a 9 to 5 has this framework, right? A 9 to 5 has this framework where you're working from 9 to 5. You're going to have to commute. You're going to spend 30 minutes to an hour getting there each way. With being an entrepreneur, sometimes it's not as structured. Maybe you're working more than 9 to 5. You're working from 7 a.m. to 7 p.m. or 7 a.m. to 9 p.m. So being an entrepreneur doesn't necessarily mean that you're going to be working less. Okay. It doesn't mean that you're going to be working less. So really, when you're trying to decide what you're going to do for money, you're really deciding what you're going to commit to in terms of your time. What are you going to do? What activities are you going to do in terms of making money? So today, what I'm going to be talking to you guys about is how are you guys going to create wealth by taking action now? And what I'm going to be talking about is how you combine things like loans, life insurance, real estate, and retirement accounts, combining all of those in very strategic ways so that you guys can create more wealth for yourselves in the future. But what's super, super important is that you begin with some kind of action. I don't know exactly what that action is, but nothing happens until you start. So get started now as the little ticker at the bottom is scrolling through. So now let's see. Let's talk about real estate first. Let's start there. Let's talk about real estate. So with real estate, if you're doing rental properties in particular, rental properties have four main ways that they make money. So with rentals, you all know that when you rent the property out, you get income. So that is cash flow. You're getting the cash flow from the property. But the other thing that people think about is appreciation. Properties go up in value. Now, that's not always the case. Not always the case, but a lot of times it is. So properties go up in value. The other thing is that if you get a loan, remember I was going to combine multiple things. If you get a loan on the property, every single month that you pay the mortgage payment, your principal balance goes down. And every single month that the principal balance goes down it's pretty much equity in your pocket. Well, it's not even in your pocket. It's equity that builds towards your net worth, right? So we're trying to build your net worth for sure, ensure a net worth in the future. You have a property, you're paying your mortgage every single month, your principal goes down, the property's free and clear later, or it has a ton of equity later, and maybe we squeeze some of that equity out. We take a loan out against the property or something like that. And finally, there is the depreciation of the property. Depreciation is more of a tax term, which is really cool because there are great ways that you can funnel money into the what they call cost basis of the property. That just means how much money you spent on the property. So cost basis creates this ability to allow you to write off money against other income. That's going to get really difficult to explain over a conversation like that. But if you have any questions about depreciation, cost basis, all that kind of stuff, let me know in the comments. And yeah, Daniel says home zone. Yes. But let's continue. Let's continue talking about how do we create wealth, right? How do we create wealth in the future by taking action now? And that was the warm up, right? Everything that I just said was the warm up. So let's really talk about it. So let's say you buy a property. And how do you buy a property? You use other people's money. How do you use other people's money? You either raise the money or you use other people's money. And these people might be Bank of America, Wells Fargo, Chase, or it might be people like Visa, MasterCard, American Express, right? you can use that money to buy a property. So it doesn't necessarily need to be your cash. It does not need to be your cash. Everybody thinks, oh, and I can't invest in real estate. I don't have the money. You don't necessarily need the money. You can borrow that money from many, many different sources. You could even borrow the money from the seller of the property, believe it or not. So if you buy the property, right, you own the property now using other people's money, all of the things that I just mentioned, you got the cash flow, you got the appreciation, you got the principal pay down, you got the depreciation, you get all of that once you own the property, right? Once you own the property, you get to benefit from all of those different things. So when you benefit from all of those things, you are ensuring that you're going to have a nice net worth or equity in the future. So when you buy the property, let's say you had the property that you bought was worth $300,000 as an example. Property's worth $300,000. You have a loan on it for $200,000. And let's say the loan is a 20-year mortgage, right? In 20 years, the $200,000 that you owe on that property will go to zero. So that means you own this $300,000 building free and clear. You don't owe anybody on that, right? So at the very least, that property, you have $300,000 in equity, but we have appreciation. So in time, that building may go up in value. So 20 years from now, if the building's worth $300,000 today, in 20 years, maybe it's worth 500 or $1 million, right? Maybe it's worth $1 million. So you became a millionaire without having to deploy any special skills. All you needed to do was own a property, right? That's all you got to do. You just got to start and you got to own the property. Nothing happens until you start. So get started now. Own a property, do something like that, right? And we can go into how to buy real estate properties. We can I run a real estate group too. If you guys want to come check out my next investor class, honesloans.com/meeting if you're interested. Tuesdays, 7:00. I teach you guys all about how to leverage other people's money to buy real estate. So you could use your credit cards, like I was saying. You can use Visa, MasterCard, American Express to be your private lenders for your real estate deal. You use them, right? You use them temporarily to buy the property, fix it up. And then when you're all said and done, you rent the property out, you go to our friends over at the big banks or the small banks or the credit unions, and we say, hey, I got this property and I need a loan. I need to refinance out of this situation that I'm in where I have financing with the credit cards. They take a look and they look at you and they're like, okay, we like it. Here you go. Here's the money. So then you pay off all your credit cards. And if you do it right, the credit cards, if you did it right, they didn't have any interest. That's the cool part. The first thing that people think of when I say credit cards, they think, oh my God, the interest. But if you're using the promotional rate, there is no interest. So use the credit cards during the promotional rate. You buy a property, you own it, you refinance with the banks, you pay off your credit cards, and now you have a regular mortgage with the banks. Voila, you're all good, right? You're all good. So that's a way to have this equity in this building later on. Now, you get some cash flow from the property, but how else can you get paid? How else can we create income from ourselves? I also mentioned that I'm going to be creating asset protection and certainty and tax benefits and all this other stuff. So how can we do that? Well, let's take a look at another vehicle. Let's take a look at the life insurance policies that I'm talking about. So with life insurance policies, you buy a policy. And when I say life insurance policies, I don't necessarily mean term insurance. Term insurance has its place, but in terms of building wealth, it's not necessarily the vehicle I would choose. I would choose a whole life insurance policy that is designed correctly. When I say designed correctly, the agent should be putting more money away towards your cash value than they are towards your death benefit. With this life insurance policy, it's got two separate buckets. It's got your death benefit, what you're all used to, and then it's got a cash value, which some of you are used to and some of you are not. So you give the insurance company $1, they take some of that dollar, they put it into the death benefit. Some of that dollar goes into your cash value, right? And so that's how you have both. You have your death benefit and then you have your cash value. So with the death benefit, you already understand that. That is what they're going to pay you when you die. Or actually, they're going to pay your family, or your heirs, your beneficiaries. They're going to pay somebody else when you die the death benefit. The cash value is where when you give the insurance company $1, they put some money into the bucket. Once the money goes into the bucket, they take the money back out. They grow the money. And if they take the money back out of the bucket, they grow the money, they put the money back into the bucket, or the money's always there, you get to leverage that money. So you may have put $1 into the bucket, but the insurance company is going to take that dollar, do stuff with it, and put $1.50 into it. You may put $2 into it. They take the money out. They do something with it. Now you have $4.50, right? So they're increasing the amount of money that's in that cash value bucket. So people often ask the question, Hone, why would I put money in that bucket just to use that money later? Because the money that you put in there is going to grow. It's going to be more than what you put in there. And so you put money in there, you pull that money back out using a loan, a policy loan. And why do you do that? To avoid paying taxes. Remember when I was saying that part of this conversation is going to show you guys how to be more tax efficient? Well, what does that mean? So if I put $1 in there and then there's $2 now because the insurance company made the money grow, there's $2 in here. I only put $1 in. That means I would have to pay taxes on that growth. So if I pulled the money out, I would get taxed, and I don't want to be taxed, and I don't want you to be taxed. So what do we do? What do we do instead? So instead of paying the taxes on it, we don't sell. We're not taking distribution. We are borrowing against it. Okay, so there's $2 in there. I'm going to get a loan from the insurance company. I'm going to get a loan. They're going to use this as collateral. I'm going to get a loan against it. And I'm going to use that money because it's a loan and I didn't take a distribution. No taxes. This conversation may be a little bit higher level for some, but I want you to get there. Don't shut your brain off because it gets a little complicated. Because if you just shut your brain off when things get complicated, you will be paying the most in taxes. That means you're going to be working harder to make the same amount of money. And why do that? Why not just be a little smarter so that you can do cool things, right? So life insurance, you give the insurance company $1, they take the money, they put some of it to pay for death benefit, some of it in your cash value. We're talking about the cash value now. So you put the money into the insurance company puts into your cash value bucket. When you need money to buy a property, let's say, you can borrow the money from the cash value that's in this bucket here. You pull the money from there. You go do your deal. You fix it up. You either sell it or you rent it out and you refinance. Either way, you're going to get money back. And when you get your money back, you pay your loan back off so that you can borrow it again. And you keep doing that back and forth, back and forth, back and forth, right? So you keep doing that back and forth. And now you have all of these properties that are providing you with income from cash flow. They are appreciating in value. You're paying down the principal, and they offer tax benefits through depreciation, right? So the buildings are providing all of this value in many different ways. And then you have this life insurance policy that is acting as your personal little piggy bank, that personal little piggy bank that's giving you the money to do your deals. Now, if you don't have a lot of money in your personal little piggy bank, maybe you can take the money from there, whatever you can, from your policy loan. You pull the money from there, and then you combine it with a hard money loan or private money loan, right? So you take some of the money from your bucket, and then you borrow hard money, and you combine the two, and then you can buy a property. Again, same thing. When you're all done, you refinance, you pay back everybody else. You pay back your hard money, you pay back your policy loan, or you flip the property, meaning you sell the property. And when you get the money from the sale, again, you pay back your policy loan, you pay back your hard money lender. Either way, you own a property now and you own another property, right? That's your portfolio. When you get older, say 60, 70 years old, whatever, your cash value and your death benefit have grown and grown and grown over the years. And say you're like, oh, I'm done. I'm not interested in buying properties anymore. What can I do now? I say, great, you have a lot of options. This is fantastic. Congratulations on living a long life. What you can do now is If you still have those real estate properties, they're going to be paying you cash flow, right? They're kicking off cash. That can be some of your income. If you need additional income, we can take that additional income from your life insurance cash value bucket, right? Remember that thing that you were borrowing from to do your deals? Now what we're going to do is we're going to take a policy loan and never pay it back. We're going to take another policy loan and never pay it back. Take another loan, never pay it back. Now that's cash flow. You guys see that? You're pulling the money, you're never paying it back. Now that's cash flow that's supplementing the income that you're getting from your real estate portfolio. Pretty cool, isn't it? So you have your real estate portfolio producing income for you. You have your life insurance policy that has a whole bunch of money in there producing income for you, right? There's also that death benefit, which is really neat. When you're old enough, there are people who are willing to invest in you, or how should I say this? They're willing to give you money, and you put them as the beneficiary of your death insurance, your death benefit of the insurance policy. So when you die, they get paid, but they're going to give you money up front, which is really cool. Or you can do something else, which is pretty clever. Let's say one of the properties that you own, or even the house that you live in or something like that, let's say that you needed a loan. Or I'm sorry, you just needed a whole bunch of money. I don't care what you need the money for. My thing is, I'm just trying to get you money. For whatever reason, why you want the money, that's your business. My job is to help you figure out how to get the money. So if you own the property free and clear, but you weren't working anymore, it might be difficult for you to get a loan, right? But you have this death benefit insurance, right? What you can do is take a reverse mortgage where the banks are paying you monthly, right? They're paying you monthly, and it's making the mortgage grow larger and larger and larger. Eventually, you die. But how the lender can feel secure in the situation is that you collateralize the death benefit for them. You say, hey, I have this death benefit here. It's going to be here when I die, and I can use this death benefit to pay off your loan, your reverse mortgage that you gave me, and voila, you should be safe. So you gave me money. You're charging me interest on that money. I'm using your money to pay the interest, so the loan is just getting larger and larger. And then when I pass away, the death benefit is going to pay off that loan. So you guys see how loans can make you wealthy and also provide you cash flow if you use it the right way. So I'm getting a loan. First, I was taking a loan from the cash value to pay for my income, right? It's giving me an income stream. And then I get a reverse mortgage on my house collateralized by the death benefit. So I'm getting cash flow from an asset that typically doesn't kick off any cash, my own house. So then when I die, the death benefit pays off the loan, and then my family, my heirs, they still own the property. The property's still within our name. Again, I'm getting like really complex with these strategies, but I hope you have an appreciation for these strategies, because this is stuff that people don't talk about. And if people don't talk about it, you don't know to do it. And so then you go throughout life trying to figure out this stuff on your own, and I don't know if you ever will. When's the last time anybody has ever broken down that strategy, that idea to you, right? I don't know if anybody ever has. So if you like this, or if you like this information, give me a thumbs up, give me a comment, right? I'd love to hear from you. Or you can send me an email. Email me at hone@honesloans.com. Again, that's hone@honesloans.com. So we can definitely go deeper into it. One of the things that you can start with is by getting an insurance policy. And I don't recommend you just get an insurance policy from anybody, because they need to know how to design these things. These things are complicated, a little complicated. It's not complicated for me because I know exactly what to do. But if you're dealing with somebody who's not really a financial person, they're just trying to sell you a policy, they don't have your best interest at heart. They just care that they get the commission. They're not interested in necessarily building a good financial foundation for you. What I'm trying to do, though, is I'm trying to show you how to leverage all of the different assets that you have to your disposal so that you can create massive wealth and have certainty in your life, right? By having a whole bunch of properties, they get paid off. You have all of this equity in your properties. You have options. You have an insurance policy, a whole life policy. When you get older in age, you're not allowed to buy a term policy anymore. So you're not going to have a death benefit to do that little trick that I just told you guys to do with. So you need a whole life policy because your whole life policy will be there at the day that you die. It's still going to be there. A term policy, for the most part, you will not use. You will never use a term policy because most term policies expire without the person using it. I think about 1% actually get used. 99% expire worthless, meaning you pay money into this term policy every single month, every single year, and then after 10 years, 20 years, whatever the term is, it's gone. You got nothing to show for it. A whole life policy, it builds cash value, it builds death benefit, and the death benefit will be there when you die, and then you get to use that death benefit as an asset later on in life when you're not working anymore, but you have hundreds of thousands, if not millions of dollars of death benefit coverage here. How can you leverage it? Well, there's a bunch of different ways. And so that's why if you talk to the wrong person, you will get the wrong advice. If you talk to the right person, you will get really, really cool advice that you go, wow, I never even thought about that. I never considered that. If you guys can do me a favor, please share this video with your friends because somebody's going to be very interested in this information and it's going to absolutely change their life. Absolutely change their life. But it requires them to get started. It requires you to get started. I'm really doing these videos so that you guys have knowledge, enough knowledge to make you confident in taking an action. The thing that people, or the thing that causes people to not fulfill on their dreams is that they just never take action. And that's a problem. That's a problem, right? So now, how else can we create wealth? So a lot of people like retirement accounts. So people have 401ks typically because a W-2 job, a 9-to-5 job has a 401k. So people have a 401k. The thing I don't like about a 401k is that you have no control of that asset whatsoever. It goes up, it goes down. Who knows? Who knows what's going to happen, right? You have no control over that whatsoever. So what I like to do is I have people create what's called a self-directed retirement account. It could be an IRA, it could be a 401k, right? But it's self-directed. What does that mean? Well, you get to direct the funds to either invest in real estate or invest in a business or to lend to other business owners, other real estate investors, and you can use it as your piggy bank to do that business, be a bank, right? When you create wealth from lending it, or when you create profit from lending it, when you create profit from renting out a property that you buy in your retirement account, all of that money that you create, all that profit, it goes back into the account completely tax-free or tax-deferred, depending on if you're doing a Roth or a traditional. So if you're doing a Roth IRA, you're paying the taxes first. You put the money into the retirement account. You direct it. Let's say you want to lend me money. You lend me money. And then when I pay you back, all of that profit goes back into the account tax-free because you already paid the taxes on it. It goes in tax-free. And then once you pass 59 and a half, you get to withdraw that money and not have to pay taxes on it. If it was a traditional, the money that you put into your retirement account, you did not pay taxes on, right? You lend me the money. I pay you back. I give you interest and your money back. That's profit. You don't have to pay taxes on it right away. When you turn 59 and a half, when you start taking the money out of that, then you do have to pay taxes on it. So that's the difference between Roth and traditional, but self-directed allows you to buy real estate properties, allows you to lend money, allows you to buy businesses. A lot of people don't know you can do stuff like that. They think that a retirement account can only be invested in a mutual fund. And that's just not true. The people who are invested in mutual funds. So let's fast forward till, and it's the year, whatever, and you are currently 65 years old and you're looking to retire. So you have your 401k, it's got all the money in it. And and then the market is down. Let's say it's the year 2050, right? It's the year 2050. You're 65 years old and you have all of your money in your 401k, but the market is down and you already quit your job and that's your only source of income. What do? Well, you have to sell some of your shares in order to have an income. And unfortunately, you're going to have to sell more shares than usual because the market is down and those shares are less valuable. You guys get me? So on down days, you're going to have to sell. On up days, you're also going to have to sell because you have no other choice. Most people only have a 401k to rely on, and most people don't have a lot in that 401k to rely on. But either way, you're going to have this 401k and you're going to sell on the down days. Well, what if you had an option? And what option might that be? Well, let's go back to that life insurance policy idea. You have your cash value in your life insurance policy, and now you have your 401k, and you have these two different buckets. This one's your life insurance cash value. This one's your 401k, right? So we're on the same page. On the years that the 401k is worth a lot, that's the years you want to sell because you don't have to sell as many shares to get the same amount of income, right? So on the years that it's up, you take an income from your 401k. On the years that it's down, you pull from their life insurance company. So you're not selling so many shares of your 401k for that same income. Really cool, isn't it? The cool part is the life insurance will not go down. This 401k thing has this crazy fluctuation. Being able to pick between the two is powerful. It's super, super powerful. So again, the years that this is up, use the 401k, and the years that it's down, use the life insurance. By doing that, you are so much more efficient. You're going to have way more income for years and years because you're going to be saving your shares. You're not going to have to liquidate your shares. The biggest fear, or one of the biggest fears that old people have, is outliving their money. Like I have a friend, she's in her retirement age, and she's constantly doing the calculation based on the stock market of how many years her money is going to last. And she goes, "Oh no, I better not live too long or else I'm going to outlive my money." So it's a very scary thing. It's a very, very scary thing. So I don't advise that. And most people don't think about this. Most people put a couple bucks away in their 401k and they think they're good. They think, oh, whatever. YOLO, you only live once. Whenever I go to retire, I retire. But I don't think that's smart. I think that's really that's bad. That's no good. Don't do that. Don't just put it to chance that way. I wouldn't do it. Have these options. Have these options because you want to have a comfortable life. I mean, you're working so hard now for all of those things. Why are you working so hard for all of those things? So I want you guys to have a comfortable life. If you're interested in real estate, though, if you're interested in real estate and learning how to buy all those properties, like I was telling you, you guys can also check out my website here, reibanking.com/REI101. That's a free course. You don't even have to give me your email address. That might change in the future, but for now, you literally go to that website and you can watch a training on real estate. Like you'll learn all kinds of stuff. It's good, but I will give you a disclaimer, right? I will give you a disclaimer. Your use of the information contained herein is at your own risk. Under no circumstances will Hone Tai be liable for any loss or damages caused by the use of this information. Yeah, I'm just trying to help you guys, right? There's a couple of things that I've learned and I'm just sharing the information, but I am by no means a CPA, an attorney, blah, 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 blah. The only license that I have is a driver's license. So, but you can still learn from me, right? You can still learn from me. This is for entertainment only, right? I'm doing this show for your entertainment purposes, folks. I would love for you guys to figure out how to create wealth for yourselves and ensure this wealth in the future. There's so many things that we can talk about. You can email me, hone@honesloans.com. If you guys want me to run you an insurance policy, an illustration to see how it how it performs, let me know. Email me there as well, and then I can create a policy for you guys, and then you can see how these whole life policies will create massive wealth for you in the cash value. You can use that to buy real estate, refinance, pay it back, and then when you go to retire, you can pull an income stream from that cash flow or that cash value. You pull it as a loan, so it's completely tax free. You don't get taxed on loans, right? You're pulling the money as tax-free income. And worst case scenario, you still have this death benefit that is a valuable asset. And so we can leverage that as well, whether you're doing that reverse mortgage and having the death benefit as the collateral so that when you do pass away, the reverse mortgage is paid off and the house is safe with the family, or you sell your death benefit off as a senior settlement, or God forbid a viatical settlement. That's where you're like terminally ill, you're going to die in like 2 years. You can sell your policy to somebody who's willing to give you money today, and then when you pass away, your death benefit pays them because they invested in you. But either way, you have all of these things, you have all of these sources of money, but you will only have sources of money if you start. If you don't do anything, nothing happens. So you have to start. And if you do start, you have a lot of choices available in your life. But as always, like I was saying before, please share this video. Like it, share it, comment, subscribe, do all the stuff that you know to do, because this video can help somebody in a big, big way. And I hope it helps you in a big, big way. If you're watching this, it means you care. You care about what's happening. I don't know what's going to happen in your future. I don't know if you're saving enough money for retirement. I don't know if you're going to outlive your money, but I do know that the information that I provide to you will help set you up in a way where you can have more certainty in your life. That's the scary thing, not having that certainty of what's going to happen if you run out of money or if you stop working or any of those things, right? So there's a lot of different ways to get into the business of real estate. There's a lot of different ways to save for a rainy day, to have net worth, to have equity, to have value, to have a retirement, to all of those things. There's so many different ways, but if you just simply follow what everybody else is doing and only investing in a 401k, you may be unpleasantly surprised in the future about how much money actually there is in there. And you don't want to find that out when you're late in life. It's like, oh, surprise, uh you don't have enough money, you have to go back to work, and that's a bad thing. I'd hate for that for you. So email me. Let's continue this conversation. Email me at hone@honesloans.com, and I would love to be able to have this conversation with you in a deeper way, and we create a plan for you so that you have more certainty for you and your family. And hey, if you figure this out, you get to break a generational curse. You get to help uh, tons and tons of people. You get to help family members that you never met, because your kids and your kids' kids and your kids' kids would be educated in this stuff. You're breaking generational curses that you didn't know existed. So if you wanna have that kind of lifestyle, let me know. I'd love to have the conversation with you. Again, email me hone@honesloans.com. All right, guys, I will see you in the next